Hello children, we will discuss with the last topic of money and credit chapter, that is credit control measures. Remember, these credit control measures are being adopted by Reserve Bank of India to control the system of credit, which has been broadly classified into two types. The first type is known as quantitative credit control measure, and the second one is qualitative or selective credit control measure. Quantitative credit control measures are being designed to regulate or control the volume of credit created by the banking system in our country, whereas qualitative credit control measures are being designed to regulate the flow of credit in specific uses. But this quantitative and qualitative credit control measures has been subdivided into different types, where we are going to learn here. The first important quantitative credit control measure is the bank rate policy. Bank rate policy is also known as discount rate policy also, where bank rate is nothing but at what rate RBI is going to lend funds to all the commercial banks of our India. Here the word lend is nothing but providing loan. It means at what rate of interest Reserve Bank of India is going to provide loans to all the banks of our country is known as bank rate. If the rate of interest on bank rate is higher, then the credit creation will be lower. If the bank rate is lower, then credit creation will be higher, which is known as vice versa. It means here, if the rate of interest by RBI to the commercial bank is higher than the credit creation, here the credit creation is nothing but providing of loan, it will be lower. What is the reason? Because when the rate of interest on a particular loan is going to be high, by the time no one is going to take any part of the loan. And there are two bank rate policy which are being adopted by RBI. The first is known as a repo rate, and the second is known as a reverse repo rate. What exactly repo rate is? Repo rate is nothing but at what rate of interest RBI is going to provide loans to all the commercial banks in our country. And reverse repo rate is nothing but it is the reverse side of repo rate, where all the commercial banks of our country are going to provide loans to the Reserve Bank of India. Now a question comes, why this bank rate policy has been adopted to control the credit situation in our country? Or what is the reason this quantitative credit control measure has been adopted by the RBI? This quantitative and qualitative credit control measures has been adopted just due to the one problem, that is known as inflation. What exactly inflation is? Inflation is nothing but increase in the prices of goods and services. When there is a increase in prices of goods and services, or when there is an inflation, it is going to affect the whole economy, due to which RBI, which is there, it is going to adopt the method of bank rate policy under quantitative credit control measure by the way of increasing a repo rate. You can see in the picture which they have given at the side, when interest rate is being hiked, by the time economic growth will be slower, and in the same way there is slower inflation as well, because due to the increase in the rate of interest, Commercial banks are unable to provide the loan because there is no individual who want to get the loan from bank, due to which it is going to affect directly to the economy of our country, where inflation is also going to come down as the marketers are unable to sell the goods and services to the individuals, because the individuals do not have any amount of money into their pocket, because the banks are not providing any kind of the loan into our country. You can see the opposite side, when the rates are being cut or when the interest rate are being cut, by that time people have huge amount of the money into their pocket, due to which they are going to purchase maximum goods and services, and in the same way it is going to help for the growth of our economy also, and by that time it is affecting to the inflation as well, because inflation is going to be increased. So this rate policy which is there, it has been adopted by RBI just to stop the problem of inflation. The second type what we are going to learn in this is known as open market operation. Here open market operation refers to the buying and selling of securities by the central banks to the commercial banks of our country. A sale of securities by the central banks to the commercial banks of our India results in the fall of total cash reserves in the commercial banks. Just due to the fall in total cash reserves into the commercial banks, it leads to the cut in credit creation power of all the commercial banks in our country. When no any bank is going to have any part of cash reserves, they are unable to provide any part of big loans to the individuals or to the public, due to which it is going to help to stop the problem of inflation, so that Reserve Bank of India is going to help to stop the problem of inflation by selling the government securities to the commercial banks and getting the part of cash reserves from the commercial banks, through which public or people are unable to get any part of cash for the purpose of purchasing the goods and services. The third important type which is there in this quantitative credit control measure, that is known as varying reserve requirement, which is also known as legal reserve ratio also. This legal reserve ratio which is there, it has been subdivided into two types. The first type which is there, that is known as cash reserve ratio, and the second one is known as statutory liquidity ratio. This may be asked in your examination for the expansion also, for the 1 marks. CRR or SLR. CRR means cash reserve ratio, SLR means statutory liquidity ratio. Now we have to learn what does this CRR means and what is SLR. Cash reserve ratio is nothing but the amount of money or the ratio of deposit which the banks are required to keep with RBI is known as CRR. One example let me give to you. If one bank is having near to around 1000 deposit with it, by that time that bank has to keep 6% of CRR with RBI. 6% of 1000 rupees is equal to 60 rupees, and the remaining amount of 940 balance is left with the bank, and this 60 rupees which has been kept by a bank with RBI is known as CRR. This amount of the money is being kept by all the banks of our country for their reserve benefits or for their future benefits. In the future, when there is an unnecessity or when there is an emergency, by that time a Reserve Bank of India is going to provide CRR to a bank along with a particular rate of interest with a principal amount also. Now, why this CRR has been adopted to control the inflation process by the RBI? A question comes. Remember, the word varying is nothing but changing. The word which has been given in the heading, varying, is nothing but what? Changing. Changing a reserve requirement here is nothing but changing, either it may be CRR or it may be SLR also. An example has been given in the image I told just now. When CRR has been changed, due to which inflation can also be going to change as well. 1000 rupees is there into the bank, 60 rupees they have kept CRR into RBI, and 940 is the balance, due to which with the 940 rupees bank is going to operate in the form of transactions accepting deposit or giving loans. When bank is going to give maximum loans to the people, people are going to have maximum money and people are going to purchase maximum, which is going to lead inflation into the market. Now, to control this inflation, RBI which is there, it is going to vary or change or increase CRR. What it is going to do? It is going to fix the CRR, just imagine, up to 20%. So out of 1000 rupees, 200 rupees a bank has to keep with RBI, and there is only just 800 rupees which are left with the bank. With this much amount of the money, a bank has to operate in the form of transactions. So just in 800 rupees a bank is going to operate. It means that they can't provide maximum loan to the people, and it is very easy to control the process of inflation also. And now let's come to the next legal reserve ratio, that is statutory liquidity ratio. Statutory liquidity ratio is the minimum amount of cash which the banks have to keep with themselves as their ratio of deposit, where the present SLR is 25% in our India, and the maximum SLR which can be is up to 40%, which should not be beyond 40%. What exactly this SLR we can understand with the image here which has been given. If there is a 1000 rupees deposit with the bank, the 20% of SLR of 1000 rupees is 200, where bank has to keep minimum 200 rupees with themselves, and with 800 they can operate in the form of transactions by giving loan for getting the profit in the name of a rate of interest. And these 200 rupees which the banks are going to keep with themselves as a ratio of their deposit, they are going to invest into the government securities or in the gold. And presently, rather than CRR, SLR, he is going to have a great demand into our India. The next important what we are going to learn today is the qualitative credit control measures. With this qualitative credit control measures has been subdivided into different types. The first important which is there, that is change in lending margin. Remember, always whenever you are trying to get a loan, you need to keep the collateral securities. What is this exactly collateral securities? Collateral security is the documents whatever are there of your property, your land, your building, whatever it may be. It is known as the collateral security. But what exactly this margin is? Margin is nothing but the percentage value of collateral security you are required to be keep in the bank for getting any part of a loan. And here, to control the problem of inflation, banks are going to change the lending margin against a particular security, which is in order to encourage or to discourage the flow of credit. The margin against of any specific securities are always determined by the central bank, and a particular change in the margin requirement will influence the flow of credit. If suppose remember, a rise in the margin requirement results in the contraction in the borrowing value of the security, and in the same way, if a fall in the margin requirement results in the expansion in the borrowing value of security. Because of this reason, always the banks are going to change the margin of lending, because to encourage or to discourage the flow of credit, just to solve the problem of inflation. The next important what we are going to learn today, that is ceiling on credit or credit rationing. Here the ceiling on credit or credit rationing is nothing but there is a maximum limit which the bank is going to fix for the purpose of loan. It means the RBI fixes the maximum amount of credit given to a particular use or sector, or the rationing of credit is done to prevent excessive expansion of the credit. If there is a maximum amount of credit which is being given to a particular sector or to a particular banking or to a particular bank, by that time it may lead to maximum loan to the people, or it may lead to maximum credit situation in our country, due to which it is going to affect our economy in the name of inflation. So the credit rationing is a method by which the central bank is always seeking to limit the maximum amount of loans and advances, and it is also trying to fix the ceiling limit for particular categories of loans and advances, because not to extend any amount of the credit to any of a bank or to a sector. For example, if any individual sector needs a loan of 10 lakh rupees today, and again 20 lakh rupees tomorrow, again day after tomorrow 30 lakh rupees, by the time Reserve Bank of India is going to fix the ceiling limit. What kind of the ceiling limit it is going to fix here? It is going to fix that in this month you are going to get the credit rationing or the ceiling limit, that is up to 10 lakh only. Within this 10 lakh only you can operate all the credit situation of your particular sector. The next important which is there, that is moral suasion. This moral suasion is a method which has been adopted by the Reserve Bank of India, just to convince all the commercial banks or to advance the credit or to reduce the credit to a certain activities. Always Reserve Bank of India is going to do these kind of the things by the way of circulars to the banks, or by the way of periodical letters. What is the reason why this RBI is going to do? This is being done by the RBI just for the purpose of controlling inflation. In this, what the Reserve Bank of India is going to do, it is always trying to request to all the commercial banks of our country just to stop providing loans to all the individuals, which is creating the problem of inflation. Where in this request it is sending the periodical letters to all the banks of our country, or it is sending the circulars to all the banks to stop the problem of inflation. And the last important which is there, that is known as direct action. Direct action is a direct control method which has been taken by RBI against the commercial banks and the financial institutions when all the other methods prove ineffective. Thus, the RBI aims at restricting the availability of credit through various measures for the purpose of regulating money supply and the consequent effects on the process and growth of the economy. Here, the word direct action is nothing but if any type or if any measure or if any solution proves ineffective. Any measure or solution is nothing but it may be in the form of CRR, SLR, credit rationing, bank rate policy, open market operation, or any other method it may be. If these all the methods are going to be proved ineffective by the time, directly Reserve Bank of India is going to take action on all the commercial banks and financial institutions to stop the method of credit situation in our country, which is creating the problem of inflation. These all the methods are being done by Reserve Bank of India just to have the proper economic conditions into our country by the way of stopping the effects on prices in the name of inflation. Until here, the topic is over. Thank you, everyone.